What is depreciation recapture in real estate taxation? Do you think you get to keep all your tax benefits forever when you're utilizing depreciation? Well, think again. When you sell, the IRS does want to get paid, and it's called depreciation recapture. Depreciation helps you lower your taxes each year, but there's no free lunch. You will end up having to pay. I'll explain what depreciation recapture is and what you should know so you don't overpay. If you're already a real estate investor and you use depreciation, then it's important that you know what depreciation recapture is and how to calculate the tax that is generated from it. By the end of this video, you're going to understand what depreciation recapture is, how to strategically plan for the future when you are selling a property, how to calculate how much your tax will be, and then ultimately what strategies are available to you to defer the taxes into the future. So what is depreciation recapture? Depreciation recapture is the IRS's way of taxing the depreciation deductions you've claimed once you sell a property. The depreciation you used for all those years you owned the property and received rental income but didn't pay tax isn't free. When you sell, the IRS classifies a recapture tax to the benefit. A key point here is this is taxed separately from your capital gains, and it's at a different tax rate. How does depreciation save you tax while you own the property? Well, every year you are forced by the IRS, regardless if you use it or not, to take depreciation against the asset, lowering the taxable income. For example, if you own a property that generates $10,000 a year in depreciation, and you've owned that property for 10 years, there's $100,000 of accumulated depreciation that you have received on that asset. Now, when you sell that asset at the end of 10 years, the IRS is going to say you've accumulated the benefit of $100,000 of depreciation, regardless if you used it or not. So make sure your CPA is using it properly. And then in turn, they're going to want to tax you on the benefit that you received over the life of that investment. So how is depreciation tax recaptured? What is the tax rate? Well, depreciation recapture is typically up to 25%. So 25% of that total recapture, like in the last example, $100,000 that you've accumulated, the tax rate would be 25%. So that would be $25,000 of tax obligated to that accumulated depreciation amount. Capital gains tax. This ranges federally as of 2025, anywhere between 0 and 20%. The highest tax bracket is 20%, and the remainder of the capital gains would be taxed at that if it's in the highest bracket. Now remember, this is the gain above your original cost basis. So if you bought the property for $500,000 and sold it for $700,000, then you have a $200,000 capital gain. This is in addition to the depreciation recapture. Also, this is only federal tax rates. Remember, many states have state capital gains taxes or business profits taxes, like New Hampshire, one of the states I do business in. So you need to account for what are the capital gains taxes on a state level and how does the depreciation affect those? Talk to your CPA. So let's walk through a quick example so that way I can visually show you. This is how depreciation recapture works. You bought a rental residential house for $500,000. You took a total of $150,000 of depreciation over the life that you own the property. You sold the property for $700,000. The capital gain will look like this. $700,000 sale price, $500,000 was your cost basis, and then you depreciated $150,000. So your total taxable gain is $350,000. Even though you only received a $200,000 profit, you're going to be taxed on that additional $150,000 of depreciation recapture. So first, calculate the 25% recapture rate on the $150,000. Next, you have the remaining $200,000 capital gain, and that will be taxed at 20% federally. So these are the two buckets you have to look at when calculating your taxes on a real estate sale. That's why it's important to talk to your CPA, look at how much depreciation you've accumulated over the life of your asset as you've owned it. That way you can calculate the 25% on the recapture plus the total estimated capital gain before you sell. Don't wait till after you sell and you have a large tax bill because that limits your tax planning. So how do we reduce or defer these capital gains and depreciation recapture? The number one method that most people use is the 1031 tax deferred exchange. This is specifically for real estate investors. In this scenario, you're going to swap your property for a like-kind property. That means another rental or income business property for the rental property that you sold. You're going to identify a new property Once you sell your property, you can then take the proceeds and buy another property that's at the same or higher basis. This helps you defer any recapture taxes and or capital gains, and you roll in your basis into the next asset. Now, be sure you use a qualified intermediary. You cannot receive the cash yourself. That's a special 1031 exchange company custodian that will hold your money and then in turn invest that money for you in the next asset so that you qualify per the IRS's rules. When this occurs, no tax is due to you upon the sale if you do it properly. Next strategy is the step up in basis. So there is a way not to pay tax in real estate. Unfortunately, you have to die. So that is a step up in basis. In the United States, when the owner of a property passes away, the property then is reassessed at the current value. And now that steps up the basis. And if the heirs sell that property for the basis, for the amount that the property appraised for upon the death, there is no capital gain and there is no depreciation recapture. The installment sale. This is a strategy. Instead of receiving all of the cash at the closing when you sell a property, you can create a mortgage or promissory note and then allow the borrower to pay you over time in payments. This will reduce your capital gains hit, but please talk to your tax professional because depending on how much of a down payment you received or the structure of the sale, you may be subject to paying some recapture tax, but this does defer much of your capital gains and depreciation recapture if you do carry or create an installment sale on the majority of your gain. Cost segregation and bonus depreciation. If you sell an asset and you have a large capital gain, and you do it in the same calendar year as buying another property that can generate high losses or large depreciation benefits, then you can somewhat offset your gain from the sale of that property. This is a timing game, so be sure that you have enough time to buy another property that same calendar year, and you will use those losses to offset the large capital gain. When is the recapture not such a bad thing and just paying the tax? Well, if you're in a low tax bracket at that time of the sale, it may be the best time to just pay the taxes because you're in a lower capital gains tax rate and you pay the depreciation recapture that will be due someday in the future regardless. If you reinvest the proceeds from the sale and continue to build wealth, then pay the tax. You don't always have to make an investment decision based on taxes. It could be a profitable business decision. And if the opportunity allows to generate more wealth, then paying the tax is not always a bad thing at the 20 or 25% tax rate rather than ordinary income rates that are 37+%. Owning the property and creating equity over that period of time. If you've generated a lot of profits over the life of owning the property, then paying the tax is not always the worst thing. In the future, we do not know if capital gains rates will be as low as they are or depreciation recapture. So the 20 to 25% tax rates are still some of the lowest that we've ever seen in America. And if you believe that you want the liquidity in cash and you do not want to keep reinvesting, it may be the right time to just pay the tax. So now that you know how depreciation recapture works and how it is calculated, we're going to dive into the ins and outs of 1031 exchanges, the nitty-gritty in it, and how to execute the 1031 exchange so you can keep deferring taxes and compounding your real estate wealth.